Well, hi everyone. Um, Hello to we have today we have the pleasure of having Valerio Scalone from the ECB. He's going to present his work, The Importance of Being Positive, Cost of Benefits of Positive Neutral Rate for the Countercyclical Capital Buffer. Before we start, let me remind you of the general format of our webinars. We try to make our webinars as close as possible to a regular seminar. During the first minutes of the talk, we will make everyone a panelist so you can control your camera and your microphone. So feel free to make questions during the talk directly. Please be mindful of the time so others can ask questions and then Valerio has some time to answer them. If you, Valerio, can also make some pit stops along the way to answer questions, that would be great too. The presentation will be until 12:50 to leave 10 minutes at the end for discussion. Without further ado, Valerio, the floor is yours.
Thanks a lot, Carlos. Thanks to everybody and to Banco Central de Chile for the invitation. For me, it's always a great pleasure to interact with you and talk of macroprudential policy and monetary policy. So today the presentation is going to be about, first of all, this work. It is a macroprudential bulletin that we recently published. It is a co-authored work that we have done with Luis Herrera and Mara Pirovano. They are also at the European Central Bank. In this work, we do a cost and benefits analysis on the positive neutral rate of the countercyclical buffer. So I'm going to spend a bit of time on this, also for the people that are less familiar with this concept. And then a second part of the presentation, since if we have time, is going to be on instead another work that is related to the same model. That is this macroprudential bulletin. We use the 3D model, and this work instead is going to be more related to monetary policy and macroprudential policy, so the interaction, and also we're going to look more at inflationary shocks. So it is going to let's say complement a bit the first part of the work. So the first part of the work is going to be really more related to macroprudential policy. In the second, instead, we're going to have more a look also at the interaction between monetary policy and macroprudential policy. But again, we thought it was also interesting to collect your feedback on that. We were curious also to since it's among the first time that we started to present also this work. This is work instead that is co-authored with Caterina Mendicino, Karin Nikolov, and Dominic Supera. And so the model is the same. So we thought it could be actually also be a nice opportunity for us also to interact on this subject with central bankers. So so let's start with this first work. So let me a bit also to introduce a bit the concept of the countercyclical buffer. So for those who are less familiar, it is a capital requirements that moves with the financial cycle. So the idea is this capital requirements is increased when the cyclical risks become high, and it is released instead when there is the materialization of cyclical risks. In the recent, especially after the COVID, we started to have instead an increasing number of jurisdictions that slightly changed the concept of this countercyclical buffer, and to the eyes of these macroprudential authorities, the countercyclical buffer, in order to be increased, we don't have to wait to have a high risk, but we can also have a positive countercyclical buffer even in a neutral environment. Neutral environment meaning also when the cyclical risks are not high. And it is, for example, what we see a lot in the euro area right now, where we have lots of jurisdictions that increase the countercyclical buffer even if their cyclical risks are pretty low. So for example, two recent examples can be, for example, Spain and Italy, that have low cyclical risks but still are increasing their capital, their macroprudential space, with the idea that this type of movement they can increase resilience of the banking sector in different phases of the financial cycle. So we're not waiting just to be in the high phase of the financial cycle, but we want to have resilience also in the early phase of the financial cycle. This can ensure resilience also in case of materialization of shocks that may occur in the early phases, and also this can also be related to, it can help in case of mismeasurement of cyclical risk. So let's say that, for example, the financial cycle is not correctly measured for some reason, because maybe we could have biased indicators, then having this positive neutral countercyclical buffer can help us also to cover against this type of risk. And another reason is also concerning resilience is that, and this, for example, was also related and learned during the pandemic, is that some risks are not necessarily related and coming from the financial sector, from the financial imbalances, but they can also be related to, for example, strong economic negative downturn. So also in that case, you want to have also the possibility to have banks that are resilient, and also as a macroprudential authority, you want to also to have the possibility to release and to create a macroprudential space, so to help banks to support the economy in this type of economic downturn. In concerning the cost, also another motivation that also was highlighted in the recent activation of the positive neutral countercyclical buffer among the different jurisdictions is that in these new high rate environments, this created the conditions for higher bank profitability. So profitability for banks is now higher, and when banks are in favorable condition, increasing capital requirements can also be easier, because it's banks are gonna have a stronger capacity of generating new capital. So this means that essentially this type of positive neutral rate, if activated under favorable conditions, can also bring to this type of reasoning, and can also support the activation, also, for example, in a high rate environment. And the activation of this type of positive neutral is therefore usually conditioned on sufficiently positive economic growth and favorable banking sector conditions. In a nutshell, what we do in this bulletin is actually use the 3D DSG model, so the recent version, that is also the one that we're going to use in the second part of the presentation, to run a cost and benefit analysis of increasing the macroprudential space. So the idea is we are going to try to rationalize and to formalize this type of ideas on the resilience and on the cost side through the lens of a DSG model, and we're going to show some simulations that support this type of the use of the positive neutral CCYB. And what we find with this approach is that indeed, with favorable banking sector condition and with gradual activations, the cost of activating this positive neutral CCYB are smaller than the standard CCYB. So the idea is that if the positive neutral rate is the positive neutral CCYB is going to be phased in during this with this graduality, and when there is high profitability, this is going to reduce the cost of activation of the capital requirement. And concerning the benefits, we find that the positive neutral CCYB can ensure resilience also in the early phases of the financial cycle. So we have an illustrative exercise that we use to support this statement, and also we show that the positive neutral CCYB can also increase the firepower of the macroprudential authority. So the idea is that we are going to show that having a higher positive neutral requirement is going to allow banks is going to allow the macroprudential authority to release the capital requirement, and therefore we're going to create more macroprudential space and more capacity for banks to support the economy. In the second part of the presentation, instead, if we have time again, I'm going to instead show the results that we get from this other paper, that is instead the paper which I co-authored with Caterina Mendicino, Kalin Nikolov, and Dominic Supera. And in this paper, that is called Inflationary Shocks, Monetary Policy and the Financial Stability Trade-off, we show how the inflationary shocks generate a trade-off between price stability and financial stability. And we show also what are the implications for monetary policy and for macroprudential policy. So again, the model that we use in these two type of exercises in the bulletin and in the paper is actually the same, and it is the new version of the 3D model. So the related work to this first part, so the bulletin on the positive neutral requirement. So please.
Sorry, can I interrupt for a second?
Sure,
Can you go
sure,
back to the
absolutely.
previous slide? On the first part, the your analysis of the positive neutral CCYB, is there a trade-off here? So, do regulators are they balancing, all these benefits of increasing firepower and resilience against the cost of maybe limiting credit growth and so I fail to
Sure.
see if there's a trade-off there.
No, of course, thanks a lot for the question. I think it's a very good question. In a sense, it's not what we do here so far. So far we do not find a net benefit. We don't do a net benefit analysis. So we consider different type of simulations. This was again more for doing an illustrative exercise, but I agree that next step in the direction could be to have a sort of net benefits analysis, because as you said, there could be there is a trade-off, right? In a sense that as it is always in this type of model, increasing the capital requirements, increase resilience, and this in this and also the macroprudential space, so the firepower of the authority in stabilizing the financial cycle, but at the same time it is also increasing the cost of capital for the economy, and therefore also the cost of lending. So in the end, this should be weighted. So what we could say here is that the net benefit, when there is but it's not what we show, no? It's more an intuition. Is that when there is the cost of capital is low, so then the net benefit of increasing the capital requirement becomes higher. So this moves us towards a higher level of capital requirement. So this is a bit the idea, but we do not formalize it here in this work. Thanks a lot for the question. So this is essentially, it's a work that is insert in there is first of all a set of academic paper that show how capital requirements can make what are the benefits and the cost of capital requirements, as we were saying. So we contribute to this literature, looking at how this type of models can say something on the use of the positive neutral CCYB. For there are also papers that highlight the role of a releasable buffer, and both from a qualitative point of view. So there is this ECB macroprudential bulletin that shows this, and there is also an empirical assessment of effectiveness of capital releases that is, for example, done more at a micro level in Quelli et al. So the idea there is that the capital to understand and to quantify how much the capital releases, so liberating the macroprudential space during, for example, the COVID crisis, helped to support the lending in the economy. So the idea here is also to help and support the policy for a discussion. So this was a bulletin that came together with, in parallel with other works that are being developed right now in ECB and the ESRB level. So there is this working group, this work stream that is done at the ECB level in order to understand the use of the positive neutral CCYB in the euro area and in the European Union. And then we also have a work at the Basel level, so with the PSG group, that is also working on the use of the positive neutral CCYB. So these are all parallel works, and this type of bulletin tries also to help and to formalize a bit the discussion, considering this type of motivation that are the ones usually provided in this type of fora. So for the model, so now let's give a look to the model. So it is again a new version of the 3D model, but remains very similar to the 3D model. Also, I know that also in Banco Central del Chile of Chile, there are people that are working also on new versions of the model. So this is for example, in Europe, there is this Mauricio's version with the open economy. So here we remain with the setting that is close to the original one. There are some differences, but for example, related to the introduction of monetary policy, and also to some adjustment that are going to help us to run some of the next exercises. So the idea is that we have households, and between households we have borrowers and savers. So we have borrowing and saving households. So these are two separate dynasties. Then we have the production sector that features good producing firms and also the production of capital and housing. We have financial intermediaries that play the key role in the model. So these financial intermediaries, they raise equity and deposits from savers, and they extend loans to either borrowing households or firms. And these banks are subject to a regulatory capital constraint. So this is going to be the capital constraint that is going to be moved by the macroprudential authority that is going to set the capital constraints, the capital requirements for banks. In the model also we have a monetary policy that is setting the policy rate via a terror rule. So a key aspect of this type of model is that all the borrowers, so firms, borrowing households and banks, can default. So we're going to go through the different agents in detail, but the idea is that all these borrowers operate under limited liability and they can default on their debt obligations. And households and firms can default on the bank loans, and banks can default on the deposits. So there is savers, they provide deposits to banks, and there is going to be in each period a fraction of banks who are going to default. And when do we have default is that when the value for each agent, when the value of the assets is going to be smaller than the liability to be repaid, which means that for borrowing households, it is going to happen when the value of the housing is insufficient to repay back the loan that's been opened with the bank in the previous period. And for capital, and for firms, this is going to happen when the value of capital is going to be insufficient to pay back the loan with banks, the capital of firms. And finally, for banks, this is going to happen, the default is going to happen when the returns of loans is going to be not enough to repay for the deposits. So the idea is that in each period, the value of the assets of each agent, so this distribution of banks and households and firms are going to be hit by an IID shock, so an idiosyncratic shock that is going to affect the value of the asset. So that means that a fraction, so depending to the shock that we get, a fraction that they get, a fraction of these banks, firms, and households are going to default. And also on the top of that, also the economy, the whole economy is going to be hit by aggregate shocks. So there are going to be shocks that are going to hit the economy, affecting also the value, the terminal value of these assets, and therefore they are going to affect the probability of default of the economy. So in each period, there is going to be a part of agents that is going to default, and this is going to fluctuate with the business cycle and the financial cycle. When the default happens, there is going to be a bankruptcy deadweight loss to the society. So there is going to be a loss, especially it's going to be paid by savers and imposing economic costs. So this is going to decrease the final economic activity, value of the economic activity. So it is going to represent a loss in terms of GDP. So for the households, we have two distinct dynasties of households that differ in their discount factor. So we have the patient households that have a higher subjective discount factor, and impatient households. So the patient households, they include 3 members. So, and these members are the savers that supply labor to the production sector, and they save, so they provide, they save in terms of deposits that they give to banks. So this is going to be a part of the funding of the bank. And then we have entrepreneurs and bankers that are a special type of agents across the patient households. And these are the ones that provide equity, so with a limited net worth, and they provide equity, the entrepreneurs, to firms, and the bankers, they provide equity to the banks. And in each period, there is going to be a fraction of entrepreneurs and bankers that are going to become workers, savers, and vice versa. So a part of savers is going to become entrepreneurs and bankers. And we do that in a way that over time, the fraction of savers and bankers and entrepreneurs remains constant over time. So this, of course, is going to simplify the analytical computations. Then we have the other side, that is where we have impatient households. So we have we have borrowers, and these borrowers, they supply labor to the production sector, and they borrow from the banks. So the borrowers, they buy housing, and they are subject to these idiosyncratic shocks that is going to affect the value of their housing, and they can optimally default if the housing value is going to be insufficient to pay back the loan that they have with the bank. So for each household, the dynasty, so the dynasty of patient households and the dynasty of impatient households, are going to pool resources together from the different agents. So there is going to be a sharing in this sense, and they're going to therefore take a consumption decisions for all the borrowers, the impatient households, and a consumption decision for all the patients. So in this way, we avoid to need to take into account about the heterogeneity across individuals. No? So we don't have an heterogeneous agent structure, and this also is again helping us in for the computational tractability. The savers, so they maximize a discounted future stream of utility. So they maximize with respect to consumption, to respect to the value of the housing, and also they with respect to the labor hours. And they maximize subject to a budget constraint where they can decide to consume, to invest in housing. They can also, in this new version of the model, invest in direct capital. So this is going to be a direct intermediation. They can invest in deposits, and also they can invest also in bank capital. And the form of income that they're going to have is labor income. They're also going to get a return for their investment, direct investment in capital. They're going to get a return from the deposits for the parts of banks that did not default, and they're going to get a profit also from the different type of activities. So, for example, from the banker's profit, the net transfers from the entrepreneurs, and also from the profits from the intermediate firms, intermediate good producers. So the idea, so to have this direct investment in capital is also to try to represent also the reality where not all the firms, they have to pass through the banks in order to get some capital, but there is also this channel that is gonna reduce the role for banks, and there is going to be a fraction of capital that is going to be instead detained directly by savers. So this is, for example, this type of capital is gonna of investment is gonna be also there is gonna be a cost that is paid by the savers, and this cost is gonna regulate how much the savers invest in this direct capital, and this is done to match the part of firms that are funded or directly by the direct finance, so they have to go through the banks. The impatient households, they receive consumption insurance from the dynasty, can individually default on their mortgage. So these are non-recourse loans, and they default when the value of the terminal houses is going to be insufficient to pay back the loan with the bank. So here we're going to have that for each agent, for each individual, there is going to be a shock omega that is going to arrive and is going to affect the terminal housing value. Also, the house prices is going to affect this terminal value. So all the shocks that are going to affect the housing prices are going to affect also the probability of default. And therefore, we're going to have a decrease, for example, in house prices related, for example, to a housing shock or to other shocks that decrease the value of the assets. We're going to have a larger fraction of agents who are going to default. And the households take into account the overall amount of mortgages and the fraction of defaulted loans, and so they maximize the discounted stream of utility subject to the budget constraint and to the banker's participation constraint. So when the households take their decision, they also internalize also the cost that is going to be related to their loans, and this is going to be decided by the participation constraint of banks. That when they're going to price the return, the their interest rate, they're going to also take into account the risk of each agent, of each entrepreneur. Of each household, sorry, here. For the firms and banks, they are ex ante identical to their own type. They receive equity among entrepreneurs and bankers with a limited net worth, and they're gonna also provide an external financing. So there is gonna be entrepreneurs and bankers that are gonna provide this equity, and banks, and firms are gonna take also external funding from the banks in case of firms, and from depositors in terms of banks. So the firms use the equity and the loans to buy capital and labor to produce the final goods through the production function, and there is going to be an explicit contractual problem between the bank and the firm. That means that banks price endogenously the default risk of borrowers. So the higher is going to be the default risk of borrowers, the higher is going to be the interest rate that they will have to pay. For banks, instead, the banks, they use... Sure, please.
This is Miguel from bank. So in that part, when you mean banks price endogenously the default risk, is there actually default? Or that does mean that you close the contract by creating a collateral constraint for firms?
So thanks a lot for the question. So a part of them, they actually default, and there is going to be a part of their so there is a collateral also there, no, a collateral requirement there implicit, but a part of this collateral is going to be recovered by the banks. There is going to be also a repossession cost, and yeah, so therefore, yeah, but there is gonna be a default in each period. Yes.
Okay, so the interest rate is gonna equilibrate in the zero profit condition of the bank.
Yes.
With all those things. Okay, gotcha.
Yes. Thanks. Absolutely. Yeah. For the banks, they use equity and deposits to give loans to firms and households, and such that the loans are equal to equity plus the deposits, so to the budget to the balance sheet constraints of the banks, and they're going to also subject to capital requirements. So the capital requirements imposes for each bank that the equity for each type of bank has to be larger or equal than a fraction ft of the loan. So if a bank lends to an agent, they are going to have to detain a fraction of this total asset in forms of capital. So this is really a simple formalization of the capital requirement, and this ft is going to be the object that is going to be moved over time, or that is going to be decided by the macroprudential authority. Banks, they have a safety, part of the deposits are insured, so there is a safety net guarantees. And also an important feature also is that the risk profile of each individual bank is not priced by depositors. So the depositors cannot price which is the bank that is more or less leveraged. It's like that. Let's assume that they cannot see this, they don't have this type of information. They are not going to ask a higher deposit rate to a more leveraged bank, and this is going to be an incentive for banks to have more leverage, and it's there that we're going to have an advantage of having the capital requirements, because the capital requirements is going to reduce the excessive leverage that is introduced by this type of friction. For the firm, the firms, they are going to maximize the net present value of entrepreneurs' equity stake, and so the entrepreneurs maximize this value conditional on not defaulting, subject to their balance sheet constraints and the bankers' profitability conditions also here. And also here, the firm is going to default if the terminal asset value is going to be insufficient to pay back the loan with the bank. So here, when this value is going to be smaller than zero, there is going to be a default, and this can happen because there is going to be an idiosyncratic shock that is going to decrease the value of the net worth of the firm, and when this happens and this becomes negative, we're going to have a default. And also here, the evolution for example, of the aggregate productivity or of the price of capital is going to affect the terminal asset value. So for example, shocks, aggregate shocks that are going to reduce the price of capital or going to reduce the productivity, they are also going to increase the fraction of agents who are going to default, because they are going to increase the case where this type of value becomes negative. So in some periods, when we're going to have, for example, an increase in riskiness, it is going to mean it's going to be, for example, represented as an increase in the standard deviation of these IID shocks, or we can have, for example, other shocks that can be aggregate and can decrease the value of capital of TFP. For the bank, also here, bankers' equities maximize conditional not defaulting, subject to the balance sheet and to the regulatory capital constraints. So the banks default when the loan returns are not enough to repay for the deposits. So also here, there is going to be an idiosyncratic shock in red that is going to hit the return of the loans, and when this return of the loans is smaller than the part of the deposit that has to be paid back, then there is going to be a default. So this is a reduced form assumption that allows us to have a fraction of banks that is going to have that is going to default in each period. So to capture bank liabilities, we also consider that there is a deposit insurance, so a fraction K of deposit is going to be insured, and that means that in any case, there is this deposit insurance will make sure that agents will recover their deposit with the promised deposit rate, whereas instead another fraction is going to be 1 minus K, and it's going to be uninsured, and that means that in this case of uninsured bank debt, if the bank is solvent, does not default, the agents, the savers, are going to get this their deposit rate that has been promised, and another part instead, they're going to get just a recovery value in case of default. So that means that the deposit rate in equilibrium will be larger than the risk-free rate, and the higher is going to be the risk in the economy, the higher is going to be the difference between the spread between the deposit rate and the risk-free rate. For the monetary and macroprudential authorities, so the monetary authorities follows a standard Taylor rule, or we also going to consider, not in the first part of the presentation, but in the second, also a strict inflation targeting. And this is very standard. This type of rule is calibrated also to follow other DSG models that are used in DCB to conduct analysis on monetary policy and also financial frictions. Like for example, the new Euro area wide model that is the benchmark at ECB for this type of DSG models. And then we have the macroprudential authority that sets the capital requirements for banks FT, and these capital requirements can be subject to a lower bound. So it is, for example, here it is something that we use in an application in the bulletin. So there is going to be a minimum capital requirement. There is going to be another part of the capital requirement that can be increased. There is going to be a positive PNR requirement, and then there is going to be a cyclical fraction that is going to move over with respect to the evolution of the financial cycle. So for example, we're going to have the credit to GDP, and in terms a cyclical part of the buffer of the requirement is going to move with respect to the deviation of the capital of the credit to GDP with respect to its steady state value. So this is similar to a standard Basel III type rule. Also something that I want to highlight here, also to avoid ambiguity on that. So the positive neutral requirement is not conceived as a structural requirement. So it is also a requirement that can be moved, that can be released with respect to the evolution of the financial cycle of the business cycle. So we do not consider it as a hard requirement, as instead it can be for other requirements that are supposed to be there in all the phases of the financial cycle. And in some exercises, we're going to have that phi CCYB is equal to 0, meaning that no matter what the capital requirement level is going to remain the same over time, and in other requirements it is going to be larger than zero, meaning that there is going to be a fluctuation. So an important aspect of the model is that the capital ratio and the capital requirement move together. So that means that the capital headroom is constant, is assumed to be constant over time. And of course, this is something, for example, there are other models that try to model more the voluntary buffer and the evolution of the voluntary buffer. It is not something that we do here, again, for analytical tractability. Please.
Yeah, Valeria, I have a question about how are you considering the countercyclical capital buffer? Are you considering as a usable buffer? It seems to me that you're considering like it's like a minimum requirement in some way. But in practice, banks can use it's a buffer, so banks can use it with. Of course, if they use it, they have to replace it. Is that being considered?
Thanks. Thanks for the question, Alfredo. So here, essentially, since the capital ratio move together with the capital requirements, when we're going to decrease the capital requirements, we're going to also assume that essentially it's going to be the capital ratio that are going to decrease. So we're going to assume that banks will use completely the space that is going to be liberated. So in other words, yeah, there is going to be a full use of a full use, no? So it's going to be fully usable, which of course this might not be the case, and there are papers that make the point that at the macro level is not necessarily the case and might depend on many aspects. So of course this is amplification that also applies in the other way around, in a sense that when we're going to increase the capital requirements, we're going to assume that the headroom is going to remain the same over time, and therefore there is going to be also a cost for all banks, whereas instead we know that some banks might have, for example, might absorb the increase in the capital requirements by using, for example, their capital headroom. So this is not necessarily the case here. But here, again, for analytical tractability, we consider that all these can be used, and a part of and in any case, a part of the CCYB is really going to move with respect to the financial cycle. But again, this not always, but it depends on the CCYB.
Okay.
Thanks. Do you have another question? Yes, I guess.
Valerio? Yeah. So maybe to understand this better, please feel free to differ if you're gonna take it on later. So these rules are preset rules that the authorities have. Do they internalize each other's objectives, like specifically in the elasticities, right? In the phi CCYB for the macroprudential authority and in the rho R for the monetary authority. So are you going to set these parameters constant, or are they going to be optimized by each authority as a result of either a Nash equilibrium or a coordination gain between both of them?
No, thanks a lot for this question. So in this case, we do not go there. I think it could be a nice, actually a nice direction to see how this can be optimized and can vary. So in some part of the exercise, we want to make the point, for example, of resilience. So we're gonna consider that this phi CCYB is going to be equal to 0. So meaning that even if you have a shock arriving, you're going to assume that there is not going to be a movement of the capital requirements, and of course this might be discussed, right? Because one could say, no, actually a part of the authority might be tempted to partially release, and so the idea here has been more to try to describe something that is, for example, the idea is that the CCYB is not necessarily used with this type of rule, right? So what we've seen is that even in periods where you have, for example, a reduction in the cyclical risks, so in this credit to GDP with respect to this deviation, macroprudential authority does not necessarily want to reduce the capital requirements. So in this case, phi CCYB would be equal to 0. In other cases, even if there is a reduction of this, there's going to be a positive effect, as it can be for deposit intra requirement. Sometimes we're going to see also, for example, in some exercise, we're going to really consider a persistent increase in the macroprudential authority. So this type of, I agree that this type of choice are going to be have a different effects in terms of how the agents internalize this. So agents internalize, for example, the type of parameter that is going to be set, but this parameter for each type of simulation is going to be, let's say, can be common for some, for example, for ROR. It can change for the different exercise for CCYB, whereas we want to show what happens with and without the CCYB. But in any case, in each case, agents are going to internalize that this is going to be the rule, and this rule is going to remain over time. Then I agree with you that, this is not necessarily the case. And I think that, again, one extension, one idea could be also to see, because these rules are actually very non-linear, in the sense that when you have an increase, for example, in the credit to GDP over its equilibrium, then you can have an increase in the CCYB, but the reduction and the release, for example, it is not necessarily gradual. It can be much more abrupt, and it does not necessarily depend on the evolution of the credit to GDP. So, for example, during the COVID crisis, since GDP were shrinking much more than credit, these indicators, this credit risk indicator, were increasing, but still all the ECB, Euro area macroprudential authorities released the current CCYB at that time. So, showing that in the end there is a strong nonlinearity. But yeah, for the exercises here, they internalize. But again, there is just one parameter, and this parameter is each time it's fixed for a purpose of the exercise. So it is not going to be optimally found.
Okay, thank you.
Thanks. So essentially, to sum up, we have two different cases. So one case is the cost of capital requirement. So two different aspects. So I want to highlight with respect to the capital requirement. So the capital requirement, on the one hand, introduce a cost. So as we were saying before, so there is this derives from the fact that there is a limited participation to the equity market, and so since equity is more expensive than debt, when we're going to increase the capital requirements, we are going to increase the weighted average cost of capital for the economy, and this is going to also give a role also to the bank's equity issue. So in this version of the model, we have the possibility for savers to transfer some net worth to bankers. So this is gonna increase the net worth of bankers, and this is a way to model the equity issuance cost. So the idea here that we're going to exploit is that when the costs of this transfer are going to be smaller, then the cost of activation are going to be smaller. So this is, for example, in line with Lang and Menno. That is also a model that is developed in the macroprudential division of the ECB with Menno, that is instead at the Bundesbank. And what they do there is to show how the cost of capital can affect the cost of activation, but they do that more in an endogenous manner. So what we're going to do here, we're going to instead playing with the parameter regulating the equity issuance cost. So it is going to be, let's say, a much more simple way, but this is going to allow us to run the exercise and to show this type of difference in the cost of activation when we have favorable condition against not favorable condition. And this is going to affect the cost that banks face when adjusting their equity, and essentially under favorable condition there is going to be a lower cost of equity, so meaning a lower cost of increasing capital requirements. On the capital requirements, so they also have a benefit side. So as we said, bank debt is not priced efficiently, so that means that the deposit rate is going to be independent of the leverage of each single bank, and this is going to be an incentive for banks to be excessively leveraged and to take excessive risk. So the benefits of capital requirements arrives there because it reduces the excessive leverage of banks, and therefore it reduces the fraction of default in the economy, which is costly. So all the borrowers and the banks are subject to idiosyncratic shocks and aggregate shocks, and the higher the leverage, the higher the probability of default of banks in the model. And we're going to have so a resilience effect. That is the idea that with higher capital requirements, we're going to have less leverage, and therefore, since we have less leverage, there is going to be a smaller fraction of agents for which the idiosyncratic shock are going to make their net worth negative, reducing the probability of default of banks in the economy. And then there's going to be also another effect that is going to be instead more the macroprudential authority that has this countercyclical action. So again, not in all the exercise, there is going to be the possibility for the macroprudential authority to release the CCYB, and during the CCYB is increased during the upturn of the financial cycle and released when there is a recession in order to support the lending. So we try to distinguish these two types of benefits of resilience and releasability and usability. And also what we see in the discussion right now is that, for example, for the countercyclical buffer and in general for the macroprudential use of capital requirements, there is a gradual shift towards more a resilience idea. So the fact that if I want to have a positive neutral requirement in this case is also because I want to be resilient. It's not just because I want to release, but it's also because I want to make sure that banks are less leveraged and therefore they have a smaller fraction of default. But of course, the way through which this type of benefits kick in, is model dependent. So for example, in a linear fashion, in a linear set like this one, for example, this releasability, we're going to see that this releasability action is going to be smaller with respect to the resilience effect, whereas instead, if we have nonlinear model, for example, a model by Castro, where he has capital requirement in a linear fashion, then we see that liberating this the releasing and reducing the bindingness of capital constraint is gonna actually have a stronger effect than here in terms of benefits in the economy. So for the calibration is based on quarterly data for the euro area. It reproduces features of macro, financial, and banking data. It is implemented into stage. So there is parameters are fixed by a set of parameters are fixed by convention, and then a rest of parameters is found so to match to minimize the distance between the target moments of the model with the empirical counterparts in steady state. So thanks to this matching, we're gonna obtain some parameters that allow us to match the target moments with the empirical counterparts. So let me just keep this for the sake of time, and for the let's go and first look at the exercise that we do for the macroprudential balloting. Then if we have time, we can go also to show a bit this application that we have instead in the original paper concerning the trade-off between financial stability and monetary policy. So in the first exercise, as you maybe you remember from the beginning, we discussed so the positive neutral CCYB is allow us to comply with the new higher capital requirements, and the idea is that this increase is going to be done when we are under favorable competition. So what we do here is to see how changing, for example, the bank's capacity in generating new capital affects the cost of capital. So if, for example, we reduce the cost of equity issuance, that means that we reduce the transfers from savers to bankers, when we're going to have an increase in the capital requirements, we're going to have a reduction in the cost of capital. So what we do here is to consider high profitability case, and again, the high profitability case here, it's lowering the cost of issuing new capital, and we're going to consider the case of a 100 basis point capital requirement activation. So it is a capital requirement activation that happens in 4 period, and we are going to move just the structural part, so to speak. In a sense, here the CCYB is going to be equal to 0, so the coefficient that moves with respect to the financial cycle, and we're going to ask banks to increase the capital requirement over time in perfect foresight. So banks internalize from the beginning that they're going to reduce their leverage, they're going to increase the capital ratio over time in the next 4 periods, and they're going to maintain this capital ratio over time. So it is going to be a convergence to a new steady state, if you want. In this case, we compare the case of this type of transition under the high profitability case, baseline profitability and low profitability. So low profitability means that we are going to reduce we are going to increase the equity issuance cost, whereas instead in the high profitability case, we're going to reduce the equity issuance cost. And as you can see, in the case of high profitability, the cost of equity, the cost of the capital requirement, both on GDP and lending, is going to be much smaller. So for example, it's going to be even 3 times smaller with respect to lending, and more than 3 times smaller and halved with respect to the case, for example, of the baseline profitability. So the idea is, if you're increasing the positive neutral CCYB or the CCYB in general, when there is high favorable condition, then the cost of equity is going to be, the cost of capital requirement is going to be smaller. Don't know if we have question on this part.
I have a question here, Valerio.
Please.
So in this exercise, you're before activating, actually before moving the CCYB with the credit cycle, you're just increasing the baseline value, right? What you call the neutral value. So as you said, it's gonna change the steady state. So I understand why lending goes down in the long run. Maybe it seems weird that eventually GDP goes back to zero deviation. Does it mean that the trend goes down, or is it like maybe firms and households eventually overcome financial frictions, and that's why GDP eventually goes back to its initial level?
Yes, big time. In a sense, it's really this point, in a sense that this type of capital requirement activation is also internalized by agents, because and this also brings to an increase, for example, in spending, because they're going to internalize that they're going to be smaller cost of default and smaller also cost of equity related to the activation. If you do that, for example, in a case of very high already available existing capital ratio, then this effect that you notice now at the end of the projection is not going to be there, and actually the effect is going to be, in terms of GDP, much more persistent, because you're not going to have this type of effect that kick in terms of instead overcoming the friction as you labeled it.
Okay.
Thanks. For another exercise that we do, always similar in the same type of logic, is that considering a gradual activation of the CCYB. And what we do here is the idea is that the CCYB can be activated early in the cycle, which means that you can start earlier to activate it. If you start early to activate, maybe you can, let's say that, for example, in the Basel limit for reciprocity, the CCYB is equal to 2.5. That means that in the mind of the many macroprudential authorities, the CCYB has this upper bound of 2.5, which is not necessarily the case of all macroprudential authorities, of course. We took just this number because it was really the threshold for reciprocity established by the Basel III requirements, and also by the regulation that has been transposed also in the European legislation. So the idea is that we want to see we want to consider two different cases. In one case, this capital requirement of 250 basis points is going to be done just in when there is the financial cycle is above the median, and in another case, instead you're starting before. So we consider, for example, a case where we have 2 years, and in the first year you have the risk that start from low to median, so you are in the up turn of the financial cycle, and then in the second year you pass from the median risk to the high risk. So if you do not activate the positive neutral requirement, the idea is that you wait for the cyclical risk to be above the median in order to start to activate. So we assume that in 1 year there is going to be an increase of 250 basis points of capital requirement. And so this is going to be the second year where the risks pass from median to high. And this is the case of the blue line, of the blue bars. Instead, we're gonna consider the case where this activation happens also before, so when the risks are from low to median. So in this case, there is going to be a positive neutral rate that is going to be increased by 100 basis points. So this is the number that we fixed for the positive neutral rate in this exercise, and then there is going to be the other 150 basis points are going to be activated later. So the point that we want to make here is that giving more graduality is going to allow banks to to comply with this new capital ratio via retained earnings. And this means that they don't have to go through the leveraging. So there is going to be a smaller cost for the economy, because essentially more graduality will imply that there is going to be a less a smaller deceleration in lending, where instead if you do that more abruptly, then in order to comply with the new capital ratio, banks will have to be faster in reducing the lending, reducing the leveraging, in the leveraging, and therefore increasing the cost for the economy. So it is a similar exercise that we report here in a different setting, but it's a similar exercise that we've done before. It's just that the point that we make here is that if you do it that more gradual, they're going to have a smaller cost for the economy. So if the positive neutral rate is a way through which you're going to proceed through a more gradual activation, then you can have also a reduction in the CCYB cost overall.
Valerio?
Yes, please.
Valerio?
So here you're proposing an exercise where instead of increasing the neutral rate right away, you do it gradually, as you mentioned. Now, when you start activating this from the first moment, do you activate the rule, or first you increase the neutral rate from 0 to whatever, to 50 basis points or whatever, and then you activate the rule, meaning 5 CCYB goes from 0 to something. You know what I mean? Like maybe if you're activating it gradually, there is a booming credit that makes you, if the rule is active, makes you increase the CCYB on top of the neutral rate, because fee CCYB is also
Yes.
active. Or maybe it's not active. Maybe you wait until you increase it to a point where you want to get to, and then from then you apply the rule. That's just a clarification question.
No, thanks. I will answer this question, then I will take also Juan's question. If so yes, here it's also another exercise where essentially we do not apply the rule that we've seen before, but it's just imagine the FITI that moves again with the perfect foresight, and the agents internalize that is going to move in a more gradual way. So this type of 250 basis point activation is going to happen in 8 quarters rather than in 4 quarters. So it is essentially agents internalize that there is going to be a smaller also cost for lending, and there is going to be this is going to imply smaller cost for the economy. I agree with you that if we introduce a positive rule of the CCYB, this I don't think we recently tried it, but it could be that there is this type of exercise of additional mechanism there, and it is true that there could be in general equilibrium some anticipation, no, from that you were saying. So I think it could be actually a nice exercise to do that. So thanks a lot. Juan?
Valerio, Mario here from the bank.
Sorry, Mario, it's not Juan. Sorry for calling someone else.
No, no worries. I have a question regarding the previous slide. Yeah, here you compare the high bank profitability, and you mentioned that the profitability was regarding to the what was the assumption that you
The
made for
equity
the
issuance parameter, not the equity issuance cost.
equity issuance
parameter.
cost?
Yes.
But I have a problem regarding that assumption, because it's not the profitability that you're changing. You're changing, it's closer to like the liquidity of the market. So it's like changing like debt to equity.
I see.
So you're not saying that the banks are more profitable in one. I totally, what I'm saying is that I totally agree with the results. I don't agree with the title that you're putting on the slide.
Yeah.
So
Yeah.
so
So you agree with the result, but not with the title, right?
I agree with the title. So maybe in this case is that markets that are financial markets that are less deep, you're gonna have these kind of problems. So
No, I see. I think it's a very fair point in the sense here, since we didn't, I mean, it was a way through which we want to make the point of profitability. The idea is that if you have
like
small, if
you are having more problem changing like cash into equity, but
yeah,
the banks are being as profitable as before.
No, yeah, I agree. I think it's a fair point. And if you I think that your interpretation is closer probably to the one, that what in the model is really done. Then it was, for us, it was a way through which was a shortcut to talk of good conditions, profitability condition. I agree that it's, probably, your interpretation is closer with respect to the one of profitability. So the fact that there is
probably you should include some sort of tax to the return over equity that you put on the you should include some sort of tax on the return on the banks to talk about profitability.
I see. It's a nice suggestion, this one of the tax. Yes.
Yeah, but I think that's a very nice result, that the one that you're talking, because here you're saying that in cases where you have less profound market, it's costly for the authority to increase the financial buffer.
Yes. I see. No, it's a good point. It's a very good point. Actually, I think that could be, we could sell it also in this way, and then maybe try this type of tax thing. Actually, we didn't think about the tax, so thanks a lot for pointing this out.
Okay.
So let me. Then we have so again, in this bulletin we do these exercises, and so these work more from the cost side, and then we also want to make a point on the resilience and on the releasability. So on the other two points. So concerning the resilience, we consider if there is an evolution, as we were saying before, between the time t+4 and t+8. Then we consider that the risk increase from low to medium to high in these different periods, and so there are these two approaches, right? The standard approach is I increase to 2.5 from the year t+4 to the year t+8, and then there is the case of the positive neutral rate, where you increase with 1 percentage point rate in the t+4 period, and you arrive with 2.5 at t+8. So what we do here is to consider, okay, we consider different type of simulation where the risk shock can hit the economy, so the increase in the standard deviation of the omega shock, so this IID shock that increase the volatility of the terminal values of the borrowers and therefore of banks, and therefore they're going to increase the probability of default. So here we consider this increase in riskiness in banks. It is going to be there to model a financial cycle downturn, and we do that in two cases. So we consider if it happens in t+4 or if it happens in t+8. So in the case we have in the standard activation, this is done when the risks. So we consider that the shocks materialize in different phases, and we show how the PNR can be beneficial for the economy, providing timely resilience. So the idea is that this timely resilience decreases the bank profitability. So we're going to have, the bank default. We're going to decrease the bank default. We're going to stabilize credit and having smaller cost of default in the economy. And the idea is that if the phasing in is already complete, the resilience is going to be higher. So we have, for example, the case where the PNR ensures. So we have three shocks essentially that hit the economy in different moments. So we have a shock that hits the economy in t+4, and this is in the red case where we didn't activate the positive neutral rate, so we did not increase the resilience. Then we have the yellow case where instead we are going to have that the shock arrives always in t+4, so when the risks are not elevated, and still there is going to be this recession. And then we are going to have the case in t+8 where we have we are in the case where we increased the capital requirements to 2.5. So essentially to interpret this figure is to consider that the same shock arrives and it has different type of recession of dynamics. In the case of T+8, the capital requirement have been increased, so we are in the blue case, and this shock is going to have a smaller effect in terms of GDP loss. Why? Because this, since banks are more capitalized, there is going to be a smaller fraction of banks that are going to go through the default, and therefore smaller losses in the economy, and also smaller increase in the risk in the interest rate, in the lending rate, because again there's going to be overall a smaller increase in the risk in the overall risk in the economy. And then we have, in the case of T+4 without the PNR, it's the case where instead we're saying, okay, in this case, we still have median risk, so there is no need to have higher capital requirements. In this case, it is the case where I'm less capitalized, and in the case where I'm less capitalized, instead the default are going to be higher, and therefore I'm going to have stronger cost of default in the economy. And instead, in the case where I introduce the PNR, I'm in the yellow case, in the yellow position. So in this case, I'm in an intermediate phase where still I didn't see it coming because I was already in a median risk environment, so I was not expecting the materialization of financial risk. But this type of shock, they provide an increase. This type of shock essentially materialized, but since I had a bit of capital requirement activated to 100 basis point, then the recession is going to be between the blue and the red case. So this is to say that the PNR ensures resilience also early in the cycle. So in the case I didn't see it coming, and it decreases the loss in terms of GDP with respect to the case where I did not move. So the idea is to advertise a bit the positive neutral CCYB as the capital requirement that allows you to be also more resilient early in the cycle. So when you don't necessarily expect the materialization of shocks, of financial shocks. And then there is, sorry, please.
Yeah, just a clarification question. In the previous graph, you are releasing, so the buffers are being released after the shock, or it's just like having a higher capital requirement?
Thanks a lot, Maximiliano. Yes, it is like the second that you said. So we don't have a release here. We don't have, and so it means that essentially I remain more. So it is really to highlight the benefits of resilience. So the idea is this shock arrive, and the fact that the banks are less leveraged is going to reduce the default probability. Thanks. And then we have this third exercise. Instead is a bit also what Maximiliano was suggesting, that instead you also want to have want to use the fact that you have more macroprudential space, and in this case we are going to release the buffer to support lending during the economic downturn, and this is going to increase the lending capacity. So in a severe recession, what we want to show here is that in a severe recession, the release of the current buffer may not be enough to limit and this limits the countercyclical action. So what we're gonna show, what we're gonna use is this lower bound on the capital requirement. So the shocks are gonna arrive. We are gonna follow this rule that we were saying, and this rule is gonna reduce the capital requirement, is going to support lending, but in the case we did not build the positive neutral rate, we're going to have less space, and therefore we're not going to be able to completely offset, to offset as much as we could with the higher capital requirement the fluctuation. So what we do in this exercise is to consider a mix of a recessionary asset price shock, so housing shock and capital price shock. So this shock, they hit the economy, they decrease the collateral of both firms and borrowers, they increase their default probability, but they reduce their lending capacity, so there is going to be a slowdown, a deceleration in lending and in economic activity, and at the same time an increase in default of entrepreneurs, firms and banks. And we consider three different cases where the macroprudential authorities does not react, a case where there is a release from 100 basis points and a release from 200 basis points. So the idea is that instead of being let's say that we had 1% of capital requirement, what we want to show is that being on 200 basis points, so considering also this additional 100 basis point of releasability and of usability of the capital requirement, can offset the negative fluctuation. So the main mechanism of this exercise is that when buffers are at 100 basis point, there is going to be this, we're going to follow here the rules. So there is phi CCYB is going to be positive, and there is going to be a reduction in the capital requirement. And in this case, so we find the case of a red line where there is no essentially this countercyclical action on macroprudential authority, and there is going to be a strong reduction in lending and on GDP around close to minus 1.5%. And then we're going to consider the case where we're going to have to release the CCYB starting from 1%, and this release is going to have an effect of offsetting, but during the second part of the projection, this offsetting is going to be actually smaller because, as we see also in the last in the right-hand chart, the capital requirement hits its lower bound. So this is done with occasionally banding constraints essentially, and with the Hockbin simulation that is integrated that is being developed by Guerrera Coello. And then we have the case instead where we have also the positive neutral rate, and in this case, since we start from higher, from 2%, following the rule, we're not necessarily going through a reduction in the we're not going to hit the lower bound, and we're going to have a stronger capacity to support lending and GDP. So this is to make the point that also having a higher space is going to provide also more capacity to more firepower to the macroprudential authority. So again, this is the final exercise that we had in the bulletin in order to advertise a bit this importance of having enough reusable space. Again, also with in line with the question that was done also before, this type of simulation is based on the assumption that banks use their capital requirement, fully use their capital requirements, which is not necessarily the case in reality. So of course, this is a caveat that we need to take into account. But overall, so the conclusion of this bulletin, of this macroprudential exercise, that we have a favorable banking sector conditions and gradual activation. The positive neutral, so this is going to reduce the cost of activation with respect to the standard environment, or to the case where the activation happens in less favorable circumstances. The positive neutral CCYB ensures resilience also early in the phase of the cycle. And finally, the positive neutral CCYB also have this firepower in the releasability. So this is more or less the conclusion of this part. So before going to the to show maybe if we have time, actually we don't have so much time, but if you want, I can also show you some exercise more related to this trade-off between inflation and financial stability. Otherwise, we can focus on that. I mean, for me, both options are fine. So I'll let you. Maybe I don't know if you have question on this part. Otherwise, I will proceed on showing some other simulation.
I have a small comment
Sure.
on what you showed us before about the build-up of the buffer during periods of high and low bank profitability. So, as I think Mario mentioned before, you're using a sort of reduced form approach to capturing the fact that during expansions, maybe issuance costs are lower. But I wonder, maybe you could think about doing something like conditional impulse responses with a very persistent shock to the capital requirement, and then you begin in one state in which the shocks in your model tell you that bank profitability is high, and you compare it with another state, another starting point where bank profitability is low. It's just my...
Yes, so essentially you're saying so the idea is that instead of doing that with this change, as you said, very reduced form, I change this equity issuance. So you suggesting to essentially during the simulation, right? So essentially, with a perfect foresight, I could have a different. No, it is what you're thinking, or
I think you can also do it with impulse responses with the stochastic, in the stochastic setting, not the perfect foresight, with a very persistent shock to the requirements, sort of capturing the transition to the higher level. But then you use different. You can do this hacking Dynara bit. You can use different starting points for the simulations for the impulse responses.
Yes. Okay, thanks a lot. I think it's a good point. Yeah. I will think about it. But thanks a lot for this suggestion, Maximiliano. Do you have other questions or? Okay, then I would be very quickly give you the flavor of this work. I mean, the positive side is the same model, so we don't have to discuss that, and we'll use really 5 minutes just to give you a bit the idea of what we do. So this is a paper that I have with Caterina Mendicino, Kalin Nikolov, that are at the European Central Bank, and Dominic Super, the Columbia Business School. And so the idea here is to more focus on inflationary shock. So what we look here is what happens, what the model tells us when we have these inflationary shocks. We focus on the supply side shock, and we ask what are the effect on what are the implications for monetary policy and macroprudential policy. So in particular, the question that we ask is, how does this higher inflation environments, what does this high inflation environment imply for the financial stability, and what are the implications for monetary policy and macro-pru? So what I would probably focus, in these 3 minutes is essentially just to give you the idea is there is with this supply side shock that we consider. This is essentially a shock in which we very persistently increase inflation. So we shock the markup, and we have an increase in inflation and decrease in GDP. And this generates also an increase in the policy rate. So in this case, we have this supply side shock. They provide this type of trade-off that is very standard between output stabilization and inflation stabilization. So it's an environment where if the central bank wants to target, want to reduce inflation, then you also will need to pay a bit more in terms of GDP. And what we see already from this shock is that this type of shock has also implication a bit on the financial stability side, because this shock, this supply side shock, reduces also house prices and capital prices. This generates an increase in default also for firms and households, and also an increase in default also for banks. So the first thing that we say is, okay, these inflationary shocks can also have implications on the financial stability side. I mean, not big as other type of shock that can be more demand driven or even financial stability shock, but they can have a shock in terms of financial stability risk. And then another exercise that we do here essentially is the key exercise that we do is to consider the case instead where the central banks aggressively target inflation, such that inflation remain to its steady state. And we see that in this case there is an amplification in the reduction of GDP. So this is this trade-off that I was mentioning before, where the policy rate is increased more in order to stabilize GDP and inflation. But at the same time, we also see that this type of increase in the policy rate is also is gonna also amplify the negative fluctuation of capital prices and house prices, especially on impact, and this is going to imply an increase in default for households and firms. And also this is going to amplify the reduction of loans, and it's going to amplify the increase in bank default. So the idea is that there is also a trade-off that is generated by this type of shock in terms of financial stability and price stability, in that the more the central bank tries to aggressively target inflation stabilization, the more it is also going to increase bank default. And then in the paper, we also have a series of exercises where we try to see also what happens when we have macroprudential authority. So the release of the CCYB, for example, in this case, that would mean that the CCYB is positive. So this would imply in this environment a partial release of the CCYB. And then we also see what happens if we have higher or lower capital requirements. I remain available for also questions. Of course, in this part, you can also contact me more also bilaterally. Feel free to reach out. I mean, we interact a lot with the staff of the Banco Central del Chile, so I would be very happy also to keep on these interactions. I don't know, Carlos, if do you want to proceed there are questions or things.
Yes,
other comments.
We have other comments or question from the audience. Very useful insights. I don't know if anybody else has more questions. Please, guys, go ahead if you have any.
Thank you.
Nobody? Miguel, you have no? Okay. Then I guess
thanks a lot.
we're okay. Thank you so much for your presentation, Valerio, again. Very insightful. We are keeping track of this literature, and this was definitely helpful for our purposes. So thank you so much.
No, thank you. It's me that thanks you. It's always a big pleasure to interact with you all guys. Thanks a lot for all the comments and questions. Super useful. So looking forward to keep interacting and discuss. So also please send me updates from your side. Okay. Thanks a lot.
Yeah. Thank you so much.
Ciao. 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 Thank you, everybody. Ciao.